Stop. Right now, the US dollar to Japanese yen is sitting at 159.20, and almost every retail trader is looking at the wrong catalyst. Core inflation in Japan just cooled further below the Bank of Japan target, and yet the yen is not strengthening. Why? Because the market has realized the Bank of Japan is trapped. There is one danger zone at 159.40 and one hidden opportunity at 158.72 that nobody is talking about. I'm going to show you both, and if you stay until the end, I'm handing out 3 precise entry and exit levels for today's session. This is not an academic report, this is your trading rescue plan. Here is your instant verdict for the next 24 hours. The bias is a bullish continuation, but we are fading the extreme top of a compressed volatility box. We are effectively in a range-bound breakout preparation phase. The trend is undeniably up. The monthly, weekly, and daily charts are screaming strong buy. But the 1-hour structure is coiling, and that requires surgical precision, not blind chasing. The one invalidation level that proves the bull structure is breaking down is 158.72. Write this number down. If we break and close below 158.72 on the 1-hour candle, the whole structure shifts from a dip buying opportunity to a potential liquidity cascade into the 158.28 zone. Right now, I want you to comment the number 158.72 below. That is your line in the sand. Commit it to memory. If that holds, buyers are safe. If it fails, the BOJ fear is getting priced in early. Let's narrate the chart from the top down, because this is where the institutional perspective changes your game. On the weekly chart, this is an unstoppable freight train. We have the price trading well above every major moving average. The 200-week average is down in the dust, almost irrelevant except to tell us how profoundly bullish the multi-year trend is. The price is miles above the 100-week average, sitting at 157.29, and that 157.29 level is actually acting as the structural anchor for the entire trend. If we ever violently correct, and we will one day, that is the absolute backstop for the bull market. But here's what most traders miss. Drop down to the daily chart. The price is stretched. I'm looking at the relationship between the 20-day average at 158.50 and the 50-day average at 158.28. Right now, we are trading about 70 pips above the 20-day. That might not seem like much on a volatile pair like yen, but look at the MACD on the daily. The histogram is shrinking. Buyers are exhausted. We are printing a positive histogram, yes, but the momentum is decelerating. That is a subtle negative divergence that the herd ignores because the price is still making new highs. This tells me we are in the late stage of the daily impulse wave. The move from 155.61, the 200-day average, was fast, and now gravity is starting to tug at the rate. Come down to the 4-hour chart. This is the money time frame for execution. The 4-hour MACD is rolling over. We have a bearish cross right on the signal line. The price is hovering just above the 20-period average at 158.95 and the 50-period at 158.65. This is a squeeze. The Bollinger Bands are contracting. In the last 24 hours, we've had a high-frequency oscillation between 158.85 and 159.40. The 159.40 resistance is not just a random number. It is the prior swing high and the upper deviation of the value area. Above that, we have 159.61, which is the liquidity void from the previous intervention panic. That's the stop hunting ground. And here is the cross-asset validation that confirms the technicals. Look at the Nikkei 225. The Nikkei is hovering near its highs, holding steady. The US dollar to Japanese yen and Nikkei have a mutual validation pact right now. A strong Nikkei pulls in foreign capital, which keeps the dollar bid against the yen as a risk-on proxy. If the Nikkei starts to roll over, specifically, if it loses the 38,500 level, that will be the first shot across the bow for US dollar to Japanese yen longs. It will signal that the yen carry trade is unwinding. Until then, The Nikkei's resilience gives the US dollar to Japanese yen technical structure a soft floor. Now focus on the 60-minute chart. The MA5 at 158.95 is curling up, piercing through the MA10 at 158.65. That's a classic microtrend initiation. But RSI is at 56. That's no man's land. It's not overbought enough for a high probability fade, and it's not oversold enough for a mean reversion dip buy. This is neutral momentum inside a raging bullish macro trend. That's a recipe for a liquidity grab. I expect a spike above 159.40 to hunt stops before the real decision is made, or a sudden slam into 158.72 to clear out the weak longs. Yesterday's Asian session changed the narrative completely because of the core CPI print. Inflation in Japan is cooling. The Bank of Japan's target is moving further away from reality, not closer. Tokyo is desperate to normalize policy, desperate to defend the yen, but the data just gave them a reason to do nothing. And the market knows this. That's why we posted a second straight weekly gain, and that's why the bearish reversal attempts keep failing. The Ministry of Finance can threaten verbal intervention all they want, but without a corresponding spike in Japanese government bond yields, the interest rate differential remains a chasm. The US 10-year yield is holding firm, and until that breaks, buying the dollar against the yen is the path of least resistance. Here's the trap. Everyone is expecting an intervention at 160. I'm telling you the intervention is less likely now, precisely because the economic data is weak. The BOJ cannot justify a hawkish hike into a cooling economy. It would shatter the Nikkei. This creates a policy paralysis. The intervention ghost is just that, a ghost. It haunts the price action, causing flash crashes, but it does not reverse the trend. For the next 1 to 2 weeks, my directional lean is higher, targeting the 160.50 zone. The exact event that invalidates this thesis is not a BOJ statement. It's a breakdown in the US equity futures, specifically the S&P 500. Since we track the liquidity tide, if the S&P 500 starts to price in a hard landing, the yen carry trade reverses violently. So keep one eye on the S&P futures. Most people will click away right now, but this is precisely where the money is made. If you're still here, you're in the top 5% of serious traders. Keep watching. Here is strategy 1, the sniper, the conservative approach. We are waiting for a break and fade failure. The trigger condition is this: price must spike above 159.40 to take out the liquidity, then immediately reverse and close a 15-minute candle back below 159.35. That is the trap. When you see that, you enter short at 159.30. Your stop loss goes exactly at 159.65, just above the liquidity void at 159.61. That's a 35 pip risk. Your target one is 158.95, the MA5. That's a 35 pip gain, giving you a 1-to-1 risk reward. If the momentum is strong, target 2 is 158.72, the invalidation level for the bull trend. That gives you a 58 pip gain, a 1-to-1.6 ratio. This setup is voided if the price consolidates above 159.40 for more than an hour without reversing. That indicates genuine absorption, not a stop hunt. Here is strategy 2, the active trader, playing the trend continuation. This is the higher probability path in a strong buy environment. You are waiting for a pullback to the mean. The entry condition is a 1-hour candle closing above 158.85, showing support at the minor structure. You enter long on the next open at 158.90. Your stop loss goes at 158.60, beneath the 10-period average, risking 30 pips. Your first target is the retest of the 159.40 resistance. That's a 50 pip move, giving you a 1-to-1.6 ratio. Upon hitting target 1, move your stop loss to break-even plus 1 pip. Trail the runner by locking profits under the 15-period moving average. If we break 159.40 on high volume, your target 2 is 159.61. I want you to enter your profit target now. Comment your US dollar to Japanese yen range for tomorrow. Let's see how aligned the community is. I'm reading them. Here is strategy 3, the aggressor. This is a high-risk momentum chase strictly for those who know how to lose small. The setup is a breakout entry on a 4-hour candle closing above 159.40. If that candle closes strong, you enter immediately at market, around 159.45. Your stop loss is tight at 159.15, behind the breakout candle's low. That's a 30 pip risk. Your target is the psychological zone at 159.90 to 160.00, the area where intervention chatter will explode. This is a 55 pip sprint. The warning is explicit here. Because of the intervention ghost, a long position above 159.40 carries a tail risk of a violent, random 100 pip crash. Only take this if you are flat before any Tokyo headlines and you have reduced your position size to account for that black swan possibility. Greed above 159.40 is the destroyer of accounts. 1 sentence to burn into your trading desk. Never risk more than 1% on these intervention prone pairs. Never hold through high-impact US data. And remember that stops are non-negotiable, especially when the Bank of Japan is lurking in the shadows. Let's lock in the vision for the next session. The one critical level you must have on your screen is 158.72. If that base support evaporates, the dip buying machine stops, and we are looking at a fast track to 157.29. If 159.40 gives way, we are magnetically drawn to 160.00. Tomorrow, our focus is going to intensify because we have the US consumer confidence data, and more importantly, the Federal Reserve's minutes release. That is the volatility engine that will test whether this breakout is real. If you want the full breakdown on Bitcoin and the S&P 500 divergence, which is critical for the yen carry trade, that video is live now. Check the end screen. Smash that like button if this analysis gave you a clear, executable plan. It tells the algorithm to deliver these institutional perspectives to more traders like you. Subscribe and ring the bell for daily coverage. The levels are set. The risk is defined. I'll see you in the next one.